August 1st, 2012, the New York Stock Exchange. It's 8 a.m., the air conditioning is humming in the server room in Mahwah, New Jersey.
Inside the Knight Capital War Room, confidence is high. They are the biggest market maker in U.S. stocks. They handle 3.3 billion trades every single day.
They are deploying a new piece of software. It's called SMARS. It's designed to participate in a new retail liquidity program.
It's supposed to be an upgrade, a specialized algorithm to grab pennies from the spread. It's standard procedure routine. Safe.
But there is a ghost in the machine, a dormant block of code from 2003. It's called PowerPeg. It was supposed to be deleted.
It wasn't deleted. It was just sleeping. And this morning, someone forgot to update the 8th server.
7 servers have the new code. 1 server has the old code. That is the physics of disaster. 1 point of failure.
9:30 a.m. The opening bell rings. The market is live. The computers engage.
Instantly, the 8th server wakes up. It sees a flag enabled. It thinks it's 2003. It engages PowerPeg.
PowerPeg was designed for testing. Its only job is to buy high and sell low, to verify that the system works. It is a money-burning machine.
And now it's live in the real market. It starts executing trades, not 1 or 2 thousands.
9:31 a.m. Traders on the floor see the volume spike. Stocks that usually don't move are vibrating.
The algorithm is aggressive. It buys the offer, it sells the bid, it creates an instant artificial loss on every single transaction.
It's hitting the bid-ask spread like a hammer. Wizard Software, a tiny company. Suddenly it's the most traded stock on Wall Street.
The price of Wizard shoots from $3.50 to $14.75 in seconds. The physics of supply and demand are broken.
Knight's internal alarms are screaming. Their position limits are shattered. They are holding billions of dollars in unwanted stock.
9:34 a.m. The engineers are staring at the screens. They see the chaos, but they don't see the cause.
Is it a cyber attack? Is it a competitor? Is the exchange broken? Nobody looks at the 8th server.
They check the network. It's clean. They check the external feeds. They are stable. The problem is coming from inside the house.
9:40 a.m. The bleeding accelerates. They are losing $10 million every 60 seconds.
Think about that mechanical friction. Every time the server cycles, it burns capital. It is an engine running on cash instead of fuel.
The CEO is on the floor. He's shouting for a shutdown, but they cannot just pull the plug.
If they pull the plug, they leave open positions. They leave clients stranded. They need a surgical fix.
But they don't have a scalpel. They have a shotgun, and they are blindfolded.
9:45 a.m. The market is in meltdown. 148 different stocks are moving irrationally. General Electric, Ford, Bank of America.
The New York Stock Exchange is reviewing trades to cancel them, but Knight is on the hook for everything else.
The engineers make a decision. They think the new software is the problem. They decide to roll back.
This is the critical moment, the fatal error. They assume the new code is the bug.
So they revert the 7 working servers back to the old version. They think this will stop the bleeding.
They are wrong. They are dead wrong.
When they roll back, they don't turn off the flag. Now all 8 servers are running the old code.
Instead of 1 server running PowerPeg, now all 8 servers are running PowerPeg.
They didn't put out the fire, they poured gasoline on it.
9:55 a.m. The volume explodes. The loss rate quadruples. They aren't leaking money anymore. They are vaporizing it.
The servers are screaming. The CPUs are maxed out. They are buying billions of dollars of stock they cannot pay for.
The SEC is watching. The banks are watching. Knight Capital's stock price begins to tank.
The irony is the efficiency. The code is working perfectly. It is executing its instructions with mathematical precision.
It was instructed to destroy the company, and it is doing a magnificent job.
10 a.m. The team finally realizes the rollback failed. They have no choice.
They have to kill the system, shut it down, disconnect the brain.
They physically sever the connection. The screens go dark. The trading stops.
The silence returns to the server room, but the damage is done.
The timeline was 45 minutes. The mechanics were simple. Buy high, sell low, repeat.
The cost is catastrophic. In less than an hour, they lost $440 million.
That is $162,000 per second. That is faster than the burn rate of a fighter jet.
That is more than their entire net income for the previous year, gone in a lunch break.
But the money is just the symptom. We need to look at the disease.
We need to look at the code, the culture, and the moment they decided to roll back instead of debug.
This wasn't bad luck. This was a structural failure of engineering discipline.
It's the most expensive IT update in the history of finance, and it ended Knight Capital forever.
Let's crack open the server logs. Let's see exactly how PowerPeg killed a giant. Let's dissect the corpse. To understand this failure, you have to understand the concept of dead code in engineering. We call this technical debt. It's code that was written years ago, served its purpose, and was supposed to be removed. But instead of scrubbing it out, the developers just commented it out or left it dormant in the background. PowerPeg was a test functionality from 2003, designed specifically to verify that their trading engine could handle high-volume orders. It was never ever meant to touch a live market environment.
And this is where the logistics of the corporation failed the physics of the software. For 8 years, that code sat there, like an unexploded bomb buried under the floorboards. Nobody touched it, so nobody feared it. Management didn't allocate the budget or the time to refactor the legacy codebase because it wasn't broken. They prioritized speed and new features over hygiene. It's the classic efficiency trap. Why spend money cleaning up old mess when you can spend money building new products?
The trigger was the update. Knight Capital was preparing for the NYSE's new retail liquidity program. They wrote new code, called SMARS, to replace the old functionality. Crucially, they decided to reuse an old flag. Think of it like a light switch on the dashboard. In the new code, flipping this switch meant execute the new retail liquidity strategy. But in the old code, flipping that exact same switch meant execute PowerPeg and burn money immediately.
That is a catastrophic failure of protocol. You never, ever reuse a signal for a contradictory command without verifying that every single receiver has been updated. The deployment team consisted of human technicians manually copying files to 8 distinct servers. This wasn't an automated cloud deployment like we have today. This was a manual payload delivery. One technician, likely tired or rushing to meet the 8 a.m. deadline, copied the new code to 7 servers, but missed the 8th one.
This created a split-brain condition. 7 servers looked at the switch and saw new strategy. The 8th server looked at the switch and saw PowerPeg. When the market opened, the system sent the signal to all 8 units. 7 of them behaved normally. But that 8th machine, operating on the logic of 2003, began aggressively buying at the offer price and selling at the bid price, aiming to hit a volume target that didn't exist. It was trying to fulfill a test loop in a live combat zone.
The monitoring team saw the erratic behavior, but their diagnostic tools were looking for complex market anomalies, not a zombie server. They wasted precious minutes checking network latencies and external feeds. When they finally decided to intervene, they made the decision based on incomplete intelligence. They assumed the new code was the problem because that was the only variable that had changed that morning. It's a logical assumption, but in this specific architecture, it was the wrong one.
This leads to the rollback. This is the moment the patient died. To fix the glitch, they commanded all servers to revert to the previous version of the software. This sounds like a safety measure, but functionally, it was an execution order. By rolling back the 7 good servers, they removed the new code that knew how to interpret the signal correctly. Now, all 8 servers were running the old code. And crucially, nobody turned off the signal switch.
It amplifies the scale of the disaster by a factor of 8. Before the rollback, one rogue server was bleeding cash. After the rollback, the entire fleet was rogue. They effectively synchronized their own destruction. It went from a localized fire in one room to a synchronized detonation of the entire building. The volume of orders flooded the NYSE so fast that Knight Capital accidentally became the largest trader in the world for about 20 minutes.
The mechanics of the algorithm were relentless. PowerPeg didn't care about price, it cared about completion. It was checking a cumulative quantity variable to see if it was done. But because of the code mismatch, That variable wasn't updating correctly. The system thought it had done zero work, so it kept restarting the loop. It was stuck in a while, true loop of buying high and selling low, executing the same losing trade thousands of times per second, restricted only by the processing speed of the CPU.
Financially, this created a massive long position. Knight Capital was accumulating stocks they didn't want and couldn't pay for. By the time they physically pulled the power cords, they were holding a portfolio of 397 million shares across 158 different companies. They owned massive chunks of Ford, Radio Shack, and American Airlines. They were effectively a warehouse full of toxic assets that were rapidly losing value. And they had zero liquidity to cover the margin calls that were about to hit.
From an engineering standpoint, this highlights the danger of manual deployments and lack of kill switches. A modern system would have an automated circuit breaker, code that says, if we lose $10 million in 1 minute, cut the hard line. Knight didn't have that hard-coded safety net. They relied on humans watching screens to manually intervene. But human reaction time is roughly 250 milliseconds. High-frequency algorithms operate in microseconds. The humans never stood a chance.
The aftermath was a fire sale. To survive the next business day, Knight had to liquidate that accidental portfolio immediately. Goldman Sachs stepped in to buy the position, but they bought it at a deep discount because they knew Knight was desperate. That difference between what the algorithm paid and what Goldman Sachs paid was the $440 million loss. It wasn't just a computer glitch. It was a transfer of wealth from Knight Capital to the rest of Wall Street, facilitated by a single technician missing a file transfer.
The servers finally cooled down, but the structural integrity of the company was shattered. By 10 a.m., Knight Capital was technically insolvent. They had lost $440 million in cash reserves that they needed to settle the trades within 3 days. In the world of high-speed engineering, if you can't clear your trades, you aren't just broke, you are a contagion risk to the entire market. The physics of the system demanded immediate liquidation.
They scrambled for a lifeline over the weekend. It was a shark tank. Competitors smelled blood in the water. Eventually, a rival firm called Getco stepped in. They effectively swallowed Knight Capital, a giant of the industry, for pennies on the dollar. The brand was dissolved. The legacy was erased. The $440 million loss didn't just wipe out a quarter's earnings. It wiped out 15 years of profit history and ended the company as an independent entity.
This disaster forced the SEC to rewrite the rulebook on digital infrastructure. They introduced Regulation SCI, Systems Compliance and Integrity. It mandated that trading firms treat their code like critical infrastructure, similar to a power grid or a dam. You are now legally required to have automated kill switches. You need inability to deploy if the checksums don't match. You cannot rely on a tired sysadmin dragging and dropping files at 8 a.m. anymore.
It also highlighted the catastrophic cost of technical debt. Companies love to cut corners on code maintenance because it doesn't generate immediate revenue. They see refactoring old code as a waste of paid hours. But Knight Capital proves the inverse economics. Saving $50,000 on cleanup and QA testing ended up costing them $500 million in execution errors. It turns out that cleaning your room is the most profitable thing you can do.
The engineering verdict is harsh but simple. If your deployment process relies on a human to manually copy files to 8 different servers, you are not a technology company. You are a gambling operation. Automation isn't a luxury, it is a survival requirement. The human in the loop was the point of failure. The system must be designed to protect itself from the humans.
And the financial verdict is about complexity. The more complex your trading engine becomes, the more fragile it becomes. If you don't understand your own legacy code, the dead parts of your system, you don't own it. It owns you. Knight Capital was killed by a ghost they refused to exorcise.
Survival in a high-risk environment means paranoia. It means assuming the update will fail. It means having a hardwired circuit breaker that cuts the connection if the loss rate exceeds a specific threshold. You don't wait for a phone call to stop the bleeding. You let the physics stop it for you.
Knight Capital is gone. The four traders have moved on. But that specific algorithm, the logic of PowerPeg, it teaches us that in the digital age, a single line of bad code is more dangerous than a bank robber. Stay solvent.
And check your flags, stay safe,